Hi, I'm Jason Fritton. I'm the CEO of Patch of Land. Patch of Land is one of the leading debt-focused real estate crowdfunding portals on the marketplace today. We launched approximately about a year ago, and in that time we've grown to a company of about 18 highly professional, highly skilled people doing millions a month in sales, and we are considered one of the leading authorities in debt crowdfunding. Essentially what we do is we provide access between professional real estate developers with a constant need for access to capital and accredited investors who have an appetite for high yield, short-term investment opportunities backed by actual hard assets. Crowdfunding is bringing a level of daylight into what has been traditionally a very dark, very opaque, very fragmented industry. We exist in the gap between the big banks, which are simply regulated against funding the type of loans that we're offering here, which are professional commercial loans, value-add loans, and the fragmented hyperlocal mom and pop lenders that exist out there and are very, very unreliable. It's a massive, massive market. But there's been a huge market gap, and that's where we come in. We're actually setting up an e-commerce-based model with a national footprint to provide access to capital where there has not been that available in the past, and in fact for the past several decades. And we're doing it in a completely open way due to the new regulation that's been put in place by the 2012 Jobs Act and the crowdfunding exemptions. Traditionally, real estate investment has been handled or been the province of people who have that network already, who have those connections, have that skill and that experience in real estate to be able to source those particular deals, to understand those particular deals, and to be able to fund them. And it's been difficult to do so. Real estate is not a cheap game. It can be very, very expensive to try and fund real estate all on your own. Crowdfunding allows me to bring 5, 10, 100, 1,000 investors together with a much, much smaller individual contribution to make a large project actually happen, and to do so in a very transparent way, very transparent online way. They're able to make investments, to understand investments, do their due diligence completely online, and make an investment within minutes from their couch in their pajamas. We currently have an application pipeline on essentially a very, very small bootstrap marketing budget of approximately about $100 million a month in real estate applications, real estate funding applications. Of that $100 million, approximately about $20 million of it is quality, and of that $20 million, about $6 to $9 million a month right now fits within our particular wheelhouse, fits within the particular product that we are currently offering. As we continue to expand into different financial products, we move further along the different yield curve, we will be able to capture a much, much larger share of that 20 million in applications that we're already getting. As of today, I'm in about 10 states. And I intend to be in 25 states by the end of next quarter. And we're going to continue expanding very, very aggressively from there. This is a massive, massive market. We consider it to be one of the fundamental backbones of real estate. It's a very insular market, and the banks simply have not been able to fund it. And it's so dark right now, it's almost indicative of the opportunity itself. We know how much volume is actually going out there, and the fact that it's being handled in back rooms by mom and pop vendors who may lend in some parts of the city and not in the other, or some parts of the state and not in another, means there's a giant opportunity for a national, standardized, reliable lender like ourselves. Currently, I'm doing $1 to $2 million a month in sales. By the end of second quarter of next year, I project to be upwards of $10 million a month in loan originations. And at that point, I'll be able to come out to the VCs with a reliable, solid sales projections of upwards of $150 million for the following 12 months. I'll be able to demand a 30 to 40, potentially even above that valuation. So we're going into this business without limiting our options. IPO is definitely on the table, considering our growth trajectory and our market share down the road. I think it is much, much more likely that we're going to be strategically acquired. Honestly, we have already seen an enormous amount of interest from existing players in the real estate industry and existing players in the lending industry as well. And I think that as I bring to market 3 to 5 years from now a user base of tens of thousands or even hundreds of thousands of high net worth, ultra net worth accredited investors, a user base of tens of thousands of professional real estate contractors, developers, brokers with a constant need for access to capital, I bring to the market a book of business in the hundreds of millions of dollars a year, and back it all up with some very scalable, very solid, very modular technology that can be essentially plugged and played into different verticals, different industries, or even different enterprise systems. I think we're going to be a very appealing target for a strategic acquisition, as one of the leviathans in the industry decides at that point that this is, this new online transparent method of capital formation is where everything is going. And do they build something like this and try and start from scratch, or do they buy? We're going to make a very appealing argument for buying. The way that we differentiate ourselves from other crowdfunding platforms is that we are much, much more tech focused. And we're very proud of the $1 million or $2 million a month in sales that we're doing. It actually puts us up there with some of the largest out there in the industry, and we're scaling that enormously. But it's really more of a consequence of our scalable systems and our modular technology rather than the other way around. I mean, again, $1 million or $2 million a month in sales is great, but in the grand scheme of things, it's small potatoes to it. For us to be truly competitive on a national or even international market, we need to be doing many, many times that, and that's not going to be possible in an e-commerce-based model, based and centralized in Los Angeles, and investing in New York, and investing in Texas, and investing in Florida, investing in Paris, without very strong technology to back it up. And that's what we're working to do. My name is Jason Fritton. I'm the CEO. I have a very strong technology background. I work to build, design, aggregate, and procure telecommunication networks, primarily for the public sector, the government, the military. I also have a very strong background in digital marketing. I've handled multi-million-dollar annual budgets in digital marketing, and I'm a serial entrepreneur. My co-founder and partner is my CTO. He has worked as the lead software engineer for one of the largest e-commerce development companies here in Chicago. He's worked on sites such as Maui Gym, on Hello Kitty, very, very large multi-million-dollar e-commerce platforms that he has designed and led a team on. He leads our technology initiatives. I have my SVP of acquisition and underwriting, and that is Doug Cochran. He has underwritten a few $1 billion worth of real estate. He's also been very active on the origination side, understands that particular skill set, and is able to train. I have Dean Matthews, who is my CFO. He comes from a structured finance background. He handled Duke Energy's real estate portfolio as well. Has also underwritten billions of dollars worth of real estate. Amy Wan is my GC. She is a rising rock star in the world of law. She's worked for the Department of Commerce. And she's helping us to solidify our position in compliance in this evolving regulatory world. I have advisors on the board as well of Patrick Gannon, who's one of the earliest folks at Lending Club, Daniel Zwern of DB Zwern, Josh Levy, who has a very strong background in as being an entrepreneur and setting up foreign currency exchanges as well, and Mark Landy, who also has, he's one of the managing partners of a very, very large real estate fund as well. I also have a CMO out of Puerto Rico, and she's worked to build content and network-based marketing standards for Disney and for other very large players, and she's been absolutely instrumental in positioning us as a brand authority. So overall, we've got a very ambitious team. I'm a big proponent of hiring people that are smarter than I am, and keeping everybody on task and on focus, and we've been very efficient with the budget that we've had. The competitive landscape in the P2P lending industry has been very, very competitive, mostly in consumer credit. Commercial real estate is a very, very different animal. I do not see anytime soon Lending Club or Prosper making large moves into this particular market. And I think if they did move into mortgages in general, it's going to be more on the consumer side, the owner-occupied mortgage, which we're staying completely away from. They are a potential acquirer for us down the road. This is a very specialized industry. It's a very hard industry to execute on. We've been very successful at this so far as we continue to build our business and to build our book. If they do choose to move into this market. It's going to be much, much easier for them to simply pick up a company like ours and roll it into their existing structure rather than trying to recreate it from scratch. We're going to be simply too far ahead on the specialized technology. So we differentiate ourselves from Fundrise and Realty Mogul and a couple other companies like them by our focus primarily in that we are completely debt-based. We do not do equity. Equity is very, very hard to scale. It can be difficult to project out. You essentially have speculative IRRs that can be based 5 to 10 years out, and it's less systematic. We wanted to become experts at something, then kind of good at a lot of different things. So we decided very early on to focus on debt. Debt is a great bridge between the old world of capital formation, offline capital formation, traditional financial institutions, and this new world of online, transparent, e-commerce-based capital formation. And we're becoming the brand leaders in that. On top of that, as I mentioned earlier, we are technology-focused. Realty Mogul and Fundrise does a very good business. I know the leadership team over there. They're very smart people. They're good companies. I love them. But they're primarily deal flow focused, origination focused. That's a good way to do business. You have to keep the lights on. At the same time, being able to scale that out without really, really good systems and really good fundamentals behind that's going to be difficult. We're working on it from the different direction. We're building those fundamental systems, those scalable systems, those policies, that technology ahead of time. And then our deal flow is a consequence of that. We are the technology platform. So yes, there's the crowdfunding industry is going to continue to evolve on the regulatory side. It has been mandated by Congress. Title III of the 2012 Jobs Act is expected to be launched next year at some point. That will allow, with a great deal of restrictions, the ability to work with unaccredited investors as well. To be perfectly transparent and honest with you, I believe that it is too restrictive and there are too many landmines in that particular piece of regulation to be able to work with. That does not mean, however, that we won't be able to work with unaccredited investors. Title IV will also be coming out. That creates Regulation A+, which is essentially a mini IPO, an IPO without the cost and regulatory headache of a real IPO. And that'll allow us to work with unaccredited as well. There are individual states where we can do intrastate crowdfunding and work with unaccredited in that way. And on top of that, there's nothing stopping us as we grow a little bit more, get a little bit more sophisticated, to simply do our shelf registration similar to what Prosper and Lending Club has done and work carefully with unaccredited investors. The funds raised in this current round will primarily be used for increased staffing and increased marketing and to solidify some of our compliance and safety net measures. We've been very proud of the fact that we've been able to bootstrap this company up to 18 people. But our pipeline is enormous and just exploding, and we need to be able to take advantage of that. I need to bring on 5 additional loan officers, a processor, some new underwriters. I need some new folks on the tech team, and those high-level software engineers do not come cheap. And some marketing support. And on top of that, that $100 million a month pipeline that we're currently seeing right now, we're getting that off of basically no proactive paid marketing, advertising. We've really just done some preliminary campaigns to get an initial COA, and that's been very successful. Now we need to move that to scale. So a good chunk of these funds are going to be able to move to a more professional, wider breadth advertising stance. Current burn rate at the moment is about $110,000 a month. That's total expense. That's before our monthly revenue is coming in. We've been growing very, very aggressively, but keeping cash flow positive in sight. We're about $7,000 off from being cash flow positive in June. I may be cash flow positive this month as well. We've got a very strong book for this month. But that's not the primary concern. This is a land grab industry. We're continuing to grow aggressively and build our moat, but we do want to keep cash flow positive in sight as we grow. I don't want to get to the point where I'm just throwing cash at a problem and cash flow positive or profitability has disappeared so far in the rearview mirror I can't see it anymore. So we're doing very well. We're being very efficient with our funds, and it's one of the reasons why I haven't gone out for a full Series A yet, simply because this $2.5 million allows me to continue to responsibly grow and deploy capital without just having a ton of useless money sitting on my books in return for a huge dilution.